Ladies and gentlemen, please welcome Brent Combest, Director of Profitability and Compete, Worldwide Partner Group.
Welcome, everyone. We're in the home stretch of WPC, and I hope you had a great week so far. Now, I think we've saved one of the best topics for last, and as you can guess by my title, one of my primary focus areas and areas of passion is the context of partner profitability. And my team's done a lot of research on this subject over the last few years, and about 18 months ago, we started having a little bit of a different dialogue with partners. They wanted to know not only about how to create net income for their business, but what it would mean for them in terms of shareholder value. And there are a number of reasons that they were curious about this. We're starting to see a lot of M&A type activity happen in our channel. We're also starting to see a lot of funding, external funding coming into our channel to help fuel growth. So as part of your long-term growth strategy, it's really important to understand these concepts and how your company will be valued should you decide to go through an acquisition or a merger. Maybe you're looking to retire or sell, or you're looking to source external funding. It's really important that we understand exactly how this is measured, and we wanted to provide you guys with some context on this particular topic. Now, today I'm going to have a number of experts joining me to discuss this. I'm going to have Mike Harvath from Revenue Rocket, who is one of the leading M&A firms and strategic consultancies in our particular space. He's got a wealth of knowledge around this topic, and he's going to share his learnings that he's gathered over the years with us today. We're also going to have one of his clients join us, Mark Seeley, who is the CEO of Intellinet. They recently did a project together, and he's going to talk you through some of the elements of what his observations are in doing those types of activities. And then we also recently had a transaction that took place, it's almost been a year now, with CompuRx and Cloud Bearing, one of our leading providers of our cloud services here in the US. And I'm going to spend some time interviewing them to have them share with us their perspectives as well. And at the very end of the session, we'll all join you guys for a bit of a Q&A. So if you have some questions, we're happily going to address those for you. Now, before I bring on some of the subject matter experts, I wanted to share our perspective with you and our learning. Like I mentioned, about 18 months ago, we really started to learn more about this particular topic. And part of that learning was investing time with a number of investment banks, venture capitalists, and companies like Revenue Rocket to really get a solid understanding of what was driving the valuation multiples for companies in our ecosystem. And we learned a number of really interesting things. The first piece was there's really two sides to the coin. There's what we call the increase factors or the increase levers, the things that will drive your valuation up. And on the other side of that, there's what we call the discount factors, or those things that will drive it back down. And I wanted to take just a couple of minutes to share with you our observations on these pieces and give you some thoughts on how you should formulate your strategy long-term to maximize each one of these. Now, as part of this, I started to put these pieces together into a story. For example, when I look at this particular slide with the increased levers, I think about the first two listed going together very closely. And when I think about revenue growth and gross margin, they are tied at the hip. Revenue growth really comes from monetizing the right revenue streams in the right way. And what I mean by that is an extension of what Kevin Turner talked about this morning. Not all revenue streams are created equal, right? You think about the four primary ways that partners monetize their business. They do it through product revenue, selling our products, as well as other products from other vendors. They have project services, managed services, and packaged IP. And each one of those revenue lines comes with a different gross margin. For example, on the product, you're going to see anywhere from maybe 5 to 20 points of margin depending on the product and the margin and channel incentive that's in place, but that's going to be the cap of it. With project services, most partners see in that range of 35 to 40 points of gross margin. Managed services in the range of 45 to 50 points. And packaged IP, this is where the real most significant opportunity is generally north of 65 points of gross margin if done right. And the other benefit around these revenue streams and monetizing the right ones, or putting the right emphasis, I should say, on them, is that the last two of managed services and packaged IP are recurring. And this is really the key piece that's driving so much explosive growth for many of our partners today is they get into that recurring revenue model. And that's where we've seen what was considered in the past a strong growth rate at maybe 20% of the business, now seeing 40, 50%, and even sometimes higher than that. So focusing on the right revenue streams that will deliver the highest level of gross margin, that are recurrent in nature, will stimulate growth. That's why I say the two of those go together so well. One way to really drive that as well is to create efficiency into your business around specialization. You hear us talk about this quite a bit, and specialization means a number of different things. In some cases, that's going vertical with your offering. In others, it may be solving a specific line of business application very consistently, or a line of business problem very consistently. A lot of times when we think about this and the benefits of it as well, whether you're making cupcakes or you're selling technology, you want to build efficiency into your business. That's what will drive down cost and increase that rate of customer acquisition. And that's why specialization makes such great sense. Along with specialization, though, oftentimes comes the ability to package what you've developed in the past into IP that can be sold on a repeatable basis. But as you're thinking about your long-term strategy, you want to pick markets that will help you to grow over the long term. And that's one of the things that we look at quite closely whenever we're examining a partner's business is, are you focusing in an area that maybe today you have a small percentage of market share, you're seeing fast growth, but there's plenty of headroom for the future for that continued expansion of your business. So those are the elements that drive up the valuation that we noticed and observed from those external sources as being prioritized. They're not the only ones, but those are the critical areas of focus. Now, on the other side of that equation are the discount factors, and there are a number that go into this particular area as well, but there were 5 of them that really stuck in our minds. And I'll start on the right-hand side of this slide with liquidity. When we think about liquidity, most of us as partners are going to have this as a particular challenge for us. We're not publicly traded, and so in many cases, you're going to see a slight reduction in the valuation multiple as a result of this. Right? So if you see, as Phil mentioned, valuation multiples for strong cloud companies in the range of 5 to 14 times EBITDA, you may see that particular rate be taken down maybe a half of a point as a result of that particular issue. Location is another one. I think of this more in the terms of socioeconomic situation of the market that you reside in. In most of our mature markets, this isn't such a problem as it is in markets maybe where there are issues preventing cloud adoption or some challenges in relation to that. I think of markets like China as an example where that's a consideration that comes into play. And then the last one is offering maturity. How do you think about what problems you're solving for your customer and what percentage of the challenges in relation to what you're trying to deliver are you enabling them to fix inside of their business, and how deep is your solution? They're going to look at that because that's a competitive differentiator that will insulate you from somebody else that maybe could come along and do it better than you can. But the big 2 pieces that I like to call out and spend some time on with partners are the first 2 that you see here, and they're very tightly aligned. The first one is leadership transferability. A lot of times when I sit down with partners and we have a conversation about their business, I see them run into the challenge where the CEO or the owner of the company is the primary seller. They are dealing with all the HR issues. They're involved with every single customer deployment. And the challenge is, if that person is so critical to the business, not only does it stifle growth and limit the ability to scale, but if a suitor comes along and buys that company and that owner has an exit from the business, what happens to it? Will it continue to be successful? And chances are it won't. So you've got to make yourself in such a situation that the business can thrive without you. Mike, who will come out in a little bit, calls this working on the business, not in the business. And I think that's a great term. But once you do start to think about implementing people and processes, you got to think about the quality of that. Right, if I'm a buyer and coming in to look at your business, or a bank that's thinking about funding your company, I almost want to look at your line of business management as somebody that I would question whether or not I would hire that individual to do that job. Can this company continue to grow with the people that will remain once you exit? And are the processes that are put in place strong enough to be able to grow the business at the current rate for an extended period of time? Now, these are the areas that we are focusing on right now and doing a lot of work around and sharing our insights on this. We'll continue to mature this as we go on. And all of the details related to this are inside of a couple of key things I wanted to call out as resources that you can benefit from. The first is a set of profitability scenarios that we've announced this week. There are 20 of these scenarios. There are things like Salesforce automation, as well as transforming the data center. And these are the first 20 that we've built, and we'll build more as time goes along. What we wanted to do with these is engage partners, and we reached out and surveyed over 1,200 partners to really learn from them about how they were monetizing the cloud across these scenarios. So we identified specifically, what are they doing in these engagements? What are the price points that they're charging? And what are the costs that are going into actually delivering these? Because the output from each one of these scenarios is the impact or benefit on net income to your business. And then we also worked with a number of firms to identify what we should apply as a valuation multiple for the various lines of revenue and scenarios, and you'll be able to see which one of these can have the greatest impact on your particular shareholder value long term. In addition to this, we've also integrated much of this work into Cloud SureStep. So you'll find tools that are there, as well as more exhaustive guidance on exactly how strategically long term you can shape your business around these things. And we'll continue to evolve this. As we learn about new partner models, as we learn about new ways of monetizing things like the Internet of Things, for example, we'll continue to add to our expertise and knowledge in this area to help inform our channel. So that's a little bit of where we're going and the direction that we're heading with our insights and the type of value we want to provide to you. What I want to do now, though, is I actually want to shift gears and bring on a gentleman that I've been working with for a number of months on this, and his company, Revenue Rocket, spends a lot of time engaging with the IT services ecosystem. They touch approximately 10% of the transactions that happen in our space across M&A today, and he's a very well-informed individual on this particular topic. And I want to give him a little bit of time to walk through his observation on valuation multiples and give you some perspective on what's realistic in terms of that. And so what I want to do now is introduce Mike and bring him out to have him share his thoughts with us. So Mike, if you want to join us. Thanks, sir.
Thanks, Brent.
There you go.
All right. Thanks, guys. As Brent mentioned, I'm Mike Harvath, President and CEO of Revenue Rocket. I started Revenue Rocket 15 years ago really as a way to give back. I had started and successfully run 3 partner companies. I'd sold all those companies. And I learned along the way that the ecosystem, the Microsoft ecosystem, the ecosystem of technology services companies, needed a competent advisor, an advisory company that could help them navigate the waters, the rather tumultuous waters of M&A and growth strategy. That was about 400 clients ago in 10 countries. We're proud to say that we have a very active business at this point, helping firms just like yours get to the next level. I want to take a few minutes and talk about the current landscape of M&A in the IT industry. The IT industry is a $4.4 trillion industry. It's a massive business. You may have heard that number a little bit this week. This number really struck me as it was assembled by one of our partner companies in the UK, Equitech, that 40% of all deals are in firms under $5 million in revenue. And that was shocking. I think most people would think that the industry would have more larger deals, but in fact, it's very much concentrated in small deals. Matter of fact, 80% of all deals are in companies under 40 million in revenue. So it's you know, and that's by deal volume, not the number of transactions. So the volume of all dollars in transactions globally, 80% of that is in firms under 40 million. The other, I think, point, which is kind of interesting, you may have, are probably getting calls in your business from folks like us and other M&A advisors and maybe even partners and competitors in the space, that year-over-year deal volume grew 15% in 2014. And we'll talk a little bit more about the velocity of growth that's going on. That velocity is increasing. And deal multiples went up about 7.5% in 2014. Before we get too far into this slide, which you can see is a bit of an eye chart, I wanted to see just a raise of hands in the audience as to kind of where you guys are from in the world. So how many folks in the room are from Asia Pac? Okay, we got a few, maybe 10%. How many of you guys are from LATAM? Got some LATAM guys? Oh yeah, okay, also about maybe 10, 15%. How many people from Europe? We got some, yeah, similar mix. And how many from the U.S.? Somebody, okay. Very diverse crowd, very good mix. All of those groups are about, I guess 10 to 20% or so of the audience. This particular chart that you're seeing on deck here is an example of all of the different steps that you guys have to undertake in an M&A process. It is a very complex process, as you can see. It's been coined by many to be the most unnatural act in business. And the fact that we do 3 or 4 of these a month, I personally can tell you that is absolutely the case. There's a lot to do. It's an area where most people will need a Sherpa or an advisor to help them navigate that. As a matter of fact, you need to assemble a cross-functional team, I think, to do an effective job. It takes about 6 months or so to get one of these deals done. Sometimes it's longer, sometimes it's shorter, depends on the complexity of your transaction. But as you can see on the bottom of this slide, there's a variety of circles that talk about different timelines, and some are 2 to 4 months. Notice the last circle, the post-merger integration circle. Post-merger integration, along with cultural dissonance, which we'll talk about in a minute, are the 2 biggest risk factors for success in mergers and acquisitions. Most small companies make a mistake with post-merger integration, and what they do is they neglect to focus on it until it's too late. They tend to come into a post-merger integration effort after the transaction is closed, and as a result, thrash for about the next 6 or 9 months while trying to integrate. Now, when you're trying to integrate dissimilar cultures and processes and sometimes markets and geographies, that is the wrong time to be doing that. So we have strongly advised that companies start post-merger integration, establish a charter and a governance structure, and work on that pre-close. A little bit about what buyers are looking for in the market. Buyers really are looking for historical and projected financial stability. Their ability to get to a return rate has everything to do with their ability to monetize that transaction in a meaningful way. And we look at the market through, some would say a more traditional lens, in that we recommend to our clients and to the market that buyers aspire to get a 20% or more internal rate of return, which means that they should get a less than 5-year payback at the profit level that should equal their investment of that acquired entity. If it's longer than that, we generally recommend that our clients don't do those transactions. We think that is challenging. Many of our clients get 30 or plus % on an IRR. That's fairly common. 3 years, 33%, 3 years or less in internal rate of return. As you can imagine, getting a return faster is better than getting one slower. But you definitely don't want to get a return that's south of 20% on IRR. The depth of vertical market and domain expertise is also something that's extremely sought after. So when you think about building value in your business, I often use the Curly's City Slicker analogy. If you guys know the movie City Slicker, Curly would hold his finger up and he would say it's about just one thing, right? I would say that's definitely the case when it comes to specialization in a business, in a technology services business. You don't want to try to cover the watershed of all markets and all technologies, because we think that that is not a formula for optimizing the business growth or profit. And it is something that is sought after by buyers. You do want to have a solid organic growth strategy, making sure that you're growing, that you're profitable. And you want to have capable and functional leaders with an adaptive culture. And Brent alluded to some of that in his presentation. Clearly, you need to have an organization that can adapt to change. Our industry has a lot of change. There's a lot of change thrust upon it. There's change constantly going on in the market. And you want to be able to bring that change down into your organization. Your ability to adapt to that change is important. Development of intellectual property is a great way to be attractive to a buyer. And the hottest areas are SMAC, as we call them, social, mobile, analytics, and cloud. What deters buyers? Poor cultural fit, Lack of focus, as I mentioned, back to cultural fit, that is a big risk area when it comes to where deals go awry, that and post-merger integration. I would recommend that people spend quite a bit of time vetting the cultural fit of a potential transaction. And I would also tell you, as entrepreneurs in the room, you'll probably know pretty quickly whether a deal makes sense, because you have a good intuition. If you walk into a room with a potential merger or acquisition candidate, and in the first 5 minutes that little voice on your shoulder is talking and says you probably shouldn't do this thing, I would listen to that voice because it's a situation where probably what you're sensing is a poor cultural fit. Lack of focus deters buyers, of course. Weak growth and profitability. There's no way as a buyer to get to a return rate if there's weak growth or up and down growth and weak profitability. Owners that are working in the business versus on the business. That's something that deters buyers. Again, they can't transition the leadership. They're not in a position to be able to, over time, have a new owner step in and be able to really run the business. And then also owners that are looking to sell out versus sell in. I think in services businesses, in order to have business continuity, you need to have owners stick around for a while. And sometimes that's a long while, sometimes it's forever, but generally never less than 1 year. I'd say buyers are ready. If you're looking to buy a company, if you're over 5 million in the US and over 3 million internationally, that you have a clear organic growth strategy that focuses on a balance of growth and profit. We architected a theory called the Rule of 45, and essentially it was built on top of some work that was done by some Harvard folks. And it basically says that there is a theoretical limit to growth and profit in our industry. And that generally, on a 3-year average, it's the year-over-year growth rate as a percentage added to your net income as a percentage can't exceed 45%. And that's generally for companies over 5 million in revenue. And if you're interested in learning more, I'd be happy to send you some information on that. Buyers are ready when they're growing at least 10% greater than their area of the market. This is a pretty important point. The market, various areas of the market are growing very quickly. As you know, cloud is growing, at 5 times the industry average growth rate, and analytics grows at, 20 or 30%, between 20 and 30% right now. So you tend to be growing faster than the market based on the area you're focused on. That you're best in class in profit and business process, and that your vertical markets are well defined, and that you have a desire to accelerate your growth. That you're financially healthy, which generally means you have no debt, and you have a little bit of cash on the balance sheet, and you're in a position to take some risk. Sellers need to consider that, in short, about half the market expects to grow, their growth to be driven equally between organic and acquisitive strategies. Half of the market expects that. 30%, almost a full third of the market, expects that they're going to grow mostly through acquisition. And only 14% expects that they're going to grow their business mostly through organic. So the takeaway is that 86% of the market is planning to grow via acquisition. In short, what this slide tells you, it is a seller's market right now. When we look at multiples and trends in IT consulting, cash versus close and earnout, typically in 2014, in the IT sector deals, they were mixed at about 60% cash, 40% what we'll call performance-based earnout or payout. Now, most people believe that earnouts don't get paid out. I don't know, I should probably ask for a show of hands. How many people in the room think that earnouts generally don't get paid out? I think I've heard that a lot in my career in M&A. The reality of the matter, though, is that 74% of the time, based on a recent study by Equitech, earnouts get paid out at or above their expected payout level. So that tends to mean, that if you can translate, that buyers are better off fixing the payout for a seller, either in cash and or a combination of guaranteed payments or seller note. And And if you're a seller, you probably want an earnout, because if you're going to stick around and you're going to do work, you can enhance your deal by being able to share in the upside. A little bit about multiples. Multiples are relative benchmarks and comparisons. They are not valuations. Critically important. We're going to show you some numbers here in a second. They are all about profitability, okay? That is the driver that allows people to get to internal rate of return. It's a driver that every deal that I've worked on in my career has been based on, and it will continue to be, I think, for investors and folks doing acquisitions. It's not about the length of contracts. Contrary to popular belief, there's industry pundits that talk about length of contracts or revenue multiples. The reason people talk about revenue multiples is because it's the only comparative benchmark that can be used, because they're not disclosing earnings. And then multiples pivot around strategic fit, the blend of reoccurring revenue and profit, and a blend of upfront cash versus delayed payout. So all of those things are levers. When you look at where multiples are today, in 2014, globally, the average deal was about 0.8 times revenue and 8.8 times trailing EBITDA. That was a measurement of just under 800 transactions globally. In North America, we've done around 400 transactions globally in 2014, and those numbers are slightly depressed in North America. They're actually at about 8 times earnings. Now, that's an average of all the deals. Some are large, some are small, and remember what I just told you, this is not a valuation. This is just an average of all those transactions. Some of them traded at 10, 12, 20 times earnings. Some of them traded at 4 times earnings. It has everything to do with, was it a financial buyer, strategic buyer? What was the details associated with the business? How healthy was it? And what's really interesting is there's a 20% expected increase in deal volume this year. Now remember, last year we had a 15% increase in deal volume, and we have a 20% increase, expected increase this year. So it is a frothy market. There's a lot going on. Getting deals done. Only 1%, amazingly enough, of deals on average get past due diligence. And I think this is generally because most buyers and most sellers attempt to do deals on their own, and they attempt to use legal and accounting advisors to do that exclusively. We think that's a mistake. We think that deal advisors, M&A advisors, assist with helping getting deals done. As a matter of fact, when we look at what our clients experience, they get to pass the due diligence phase 93% of the time. We get deals done 91% of the time. And to that end, I'm going to introduce one of my friends, colleagues, and clients, Mark Seeley, who's in the 91% category, to tell you a little bit about his experience.
Great.
Thanks.
Thanks, Mike. Again, my name's Mark Seeley, CEO of Intellinet, and our firm has been around for about 22 years, and I've been, a little bit about myself, been with the firm for about 19 years, so in a variety of different roles, from sales, sales management, consulting management, and recently in the executive side as CEO for the last 5 years. And because of that context, I've had the role both as a contributor to a C-level executive and also recently within the idea of a partial owner. So hopefully in that context, whether you're an owner, C-level executive, or a contributor that wants to make a business transformation to your client, you'll get some elements out of this discussion as well today. So a little bit about the company, and really I want to focus on the last 5 years, the purposeful transition that we made within the business strategy. Our firm's headquartered out of Atlanta, Georgia, in the US. Started as an SI, or systems implementation firm, really around the back office, MS Mail. And for the most part, as the Microsoft back office grew, we continued to grow the offerings about what we did. And from the profile perspective, if you gave out valuations based on number of customers, delighted customers, happy employees, we'd be worth billions. But the context in this shifting marketplace that we all saw within 9/11 and really the advent of cloud is that the marketplace shifted. And so as we came to WPC and other events back in that time period, we had to make a decision as some of our revenue was declining, both on marketplace trends for the most part, and things that we saw, meager profit, some corporate debt, where we said we can continue to go down the path and hope that these things don't change, or the play back then was really go all in towards the cloud. And so we went to our board and to my partner at this point and our chairman and said, we've got to make a decision to realign our business, not throw away what we've done, but to realign our business to be relevant towards the marketplace where it's going in the next 5 to 10 years. So we made this decision back in 2010 to realign towards a series of service offerings. That the net was that our revenue, we cut back some things that were not profitable, really gearing towards the idea of profitability is key. We'll talk about some of those lessons learned. But really that has allowed us to have an advent for 3x revenue growth and really 15x valuation. The more that we focused on our business, primary towards customer-centric solutions, and while we leveraged Microsoft as a key partner, it wasn't Microsoft as our CEO almost. It was us driving the strategy, leveraging Microsoft for business transformation excellence. On the offering side, we decided in the context to start with the cloud. We went heavy on that, very strong onto Office 365 and Azure. Got a lot of POR revenue to be able to help, in essence, our shrinking patch of ice as that transformation was working, really in the SI channel. And decided to reinvest in either the broad spectrum of management consulting, strategy process, program management, execution, et cetera, or managed services. My background was from Accenture, and so one thing that I'd look at or encourage you guys to do is think about your background, think about your team's background, and what would be the easiest avenue, whether that's IP creation, or whether that's productization, whether that's management consulting, managed services, for a broader complementary skill set. We started with management consulting and have led that, and it's been strategic to our growth to be able to gear towards business problems that then have a technology-enabled solution set. We continued with our back office technology as that avenue has grown substantially as well. And then we wanted to be able to have offering end-to-end services to our customers. We did that, as Mike mentioned, through a M&A environment and sort of selected through about 100 different companies that we looked at, including about 15 or 20 that we did deep dives on. What was the right fit for us strategically as a company? So while we had organic growth, which was around 2x, we made sure that was materially successful, but we wanted to accelerate that growth to be able to have managed services, and that was a great fit for us to bring the Northeast part of the year and the Southeast part of the year together to be able to have some synergies for value-added end-to-end solutions. Now, while we were focused on awards and customer sat and everything else early on and not on profit, our focus on profit didn't deter the idea of customer satisfaction, client readiness, employee regard, and Microsoft awards. Actually, that accelerated it to the point of there was probably about 20 or 30 awards that we had, industry, trends, culture, best places to work in the US and beyond, because we focus on a great environment. Profit, in essence, allowed us to give back to our teams for investments. It allowed us to be able to grow in avenues that we had not been able to do. And from that, a lot of awards came from that strategic bet. So our path to profitability was a hard one. It sounds great in the sense of 55 months in a row, and we're proud of that. But I'll tell you the first 6 to 12 months for my leadership team were many, many sleepless nights. It'd be known that I'd call it a leadership team after work because we didn't want to get away from clients during the day, 5 o'clock, and the running joke was, hey, honey, I'll be home at 2 a.m. Mark's got a 2-hour meeting. And the context was transformation is not easy. There's hard decisions that need to be made. There's business process, there's strategy, there's investments that need to happen. And the one thing that I'll say to my partner and our chairman when he gave me the opportunity to step into the CEO role is he said, instead of giving you 50 different initiatives and thoughts of how I've run the business for the last 16 years, I'm going to give you one principle. And the principle was you must remain profitable at any size. And that was it. Beyond that, it was full carte blanche as far as what we were doing. But I think, and I've told him in the past as well, it's one of the smartest avenues because a lot of the ideas that we get into, whether it's there's lots of free money out there or cheap money out there from PE or otherwise, but you've got to be able to be a good steward of what you've got. In some cases, that takes courage, it takes leadership to be able to say, we've got to cut back some avenues to be able to reinvest. There was no additional line that we could go to. It was all through our own volition. So we had to make tough decisions and lead boldly in sort of uncharted territories that could be great, ended up being great, but could also take the company. So that's really, we looked at a revised vision statement to be, instead of customers first, people second, and profitability will take care of itself, to build a profitable, growing company that delights customers and provides an excellent employment experience for employees. And profit on purpose was job one. We revised our mission statement as well, from the idea of anytime Microsoft would release a new service offering, we'd have a big spike in our business and we'd write it down and try the early the early adopters and laggards. We changed our mission statement to be around business transformation of our clients through strategic technology-enabled business solutions. That strategy was all around the management consulting that got the executive levels, that have really fueled our growth to align to the KPIs of the business, not to the IT executives as well. I've never talked to a CEO that has known what version of SharePoint they're on. Never, in 22 years. However, every single executive will rattle off uniquely and clearly their KPIs, their objectives for customer segmentation, employee growth, regional growth, et cetera. The more that we as partners can align to KPIs, business transformation through technology versus the opposite, the more that we can have advantage towards being a strategic partner. We also emphasized the idea of a chassis that we would grow. This was heavy towards people, process, and the products that we would have, the services that we would have. We were very process-driven towards what we did. The context of any of the decisions that we made around the people or the process or the services was we want to be able to scale organically or through acquisition to 5x the size that we were in any investments that we'd make. So the people weren't going to fill just this spot, but they could, anybody that we had, any systems that we were to be able to undergo, we want to be able to say that system or that process could grow us from 8 to 35 to 50 million. That was the minimum threshold. So sort of think advanced as far as what you're doing. Now what that allowed us to do was to, again, to grow organically to a 2x number. But it also gave us the confidence when we had an M&A consideration, when we actively looked at buy-side considerations for mergers, we knew that our processes and our people and our services could absorb well that culture and the process for success. The last element there is the aligned team. In this process concept and in the strategic changes that come along with it, the desire that we had as a leadership team was to be able to share back with our company. And that profit sharing plan, even when there was debt on the books, was critical. It didn't stop until we wait till the debt gets cleared. It's day one. We're all in this together. We're giving back excess profit to the employees, excess profit through our Intellinet Foundation, which has now given over $250,000 to charities in our local communities. And that was in key to be able to say there's more than just money here. We're impacting lives in our communities in being stewards. So that's on the profitability side. I'll have last two topics here on M&A and really lessons learned. When we looked at the idea of bringing in another company, again, the key things that I want to have you guys consider was no M&A strategy within your organization. Again, an M&A, if you're bringing somebody in, will not solve your problems. On the contrary, it will exacerbate any issues that you have. So if you have process issues or people issues or management issues or leadership or vision, whatever that is, if you bring somebody else in, it will not solve it. You've got to be able to be clear on what you're doing and have M&A as an additive element to what you're doing. Again, look at M&A in the sense of accelerating. There's build versus buy scenarios. If you want to accelerate the idea of a service offering, a region, a channel, whatever that is, that's a great avenue towards modeling the value of what that looks like. Enlisting a strategic advisor. We had used Revenue Rocket as well. It was a great experience for us to be able to look at a broader spectrum that they would own and drive while I and our leadership team ran our business. It's way too complicated to do both. Enlisting a broker that understands the value and the values of what you're trying to do is strategic. Again, this is not a shell game of whatever else. Integrity matters in M&As. Integrity matters in business. I'd really, truly look for complementary cultures and people and truly try to find a win-win-win scenario for yourself and your team as well as for the company that you're assimilated in. When you do that, not only will the first 3 months and 6 months work, but the next 3 to 6 years will work out well to where you have that synergy that's very clear towards what you're doing. As far as the last slide around lessons learned, So having done this integration with another great firm, great people, great culture, you see the ideas, and at first blush, it's, wow, this is it's a perfect fit, a match made in heaven. And then once you get under the covers and you figure things out, it's like they squeeze the toothpaste tube from the bottom, and I squeeze it from the top, right? The whole philosophy of what seemed the exact same on the front end is slightly different in practice. So the lessons that I'd say on due diligence is be clear on your metrics, expectations. What do you both want out of it? What's the reason for why you're doing it? If you have clarity on the why, then the issues that come up will be minuscule, because it's a bigger goal and a bigger opportunity than the issues you might have. Understand the strengths of both firms and position people and processes to be advantageous for both firms. And be choosy on what you're looking at. We again looked at about 100 companies. There's a list of companies that we're looking at that are sort of secondary, but make sure that your first avenue is your right avenue. People are key. We hear that all the time. The pace of desire to get things integrated sometimes may slow down based on people elements. So it's always a balance, but understand pace and people sometimes come at odds, and just pragmatically look at that avenue. Change is hard in M&As. As much as companies have done well and they continue to do well because of their operations, eventually you have to choose a single chassis. You have to choose a single lead. You have to choose a single structure upon which to run your business. And that change management function is critical to success. And then again, reviews, status reports. Mike talked about post-merger integration teams, status reports, open communication to the team, over-communicate the idea of where we're going, expectations so they can understand how that fits into what they're doing, and have that clear vision for the company. When you have alignment on the people, the process, and the technology, as well as the avenues for their career growth, there's great opportunities. And the last thing I'd sort of leave you with is, again, these are trying times. We talked about, or Satya and Kevin talked about avenues of year of transformation and disruption in the industry. I think we're going to see that more and more. Our businesses as SIs, ISVs, et cetera, are changing. And so I'd encourage you to look back at where your opportunities have been in the past, what your avenues are now, and lead boldly, because your team will thank you for it. So thanks for your time. I'm going to bring back up Brent, and I'll be back for questions at the end.
Thank you, Mark. Appreciate it. Yeah, thanks both Mark and Mike. There were a lot of great insights in there. I'd say a wealth of insights learned there for me in particular, and through the conversations I've had the pleasure of joining them with over the last few months. A couple quick call-outs on it. One is, learning is buyers are looking at valuations of EBITDA or profit, not necessarily revenue, right? If I buy a company for $10 million that's not turning a profit, I'll never get my money back. So it's important to really understand that concept and be rational in what the valuation multiples are that you're expecting. The other thing that was just staggering to me is just how large or how many transactions are taking place in our ecosystem today. The fact that there were roughly 800 last year with an expected growth rate of 20%, this is a very active, very busy market right now. So either if you're on the buy side or the sell side, it's definitely something to consider as you're building your growth strategy. And what I want to do now is actually bring out a partner that does have this type of activity as their growth strategy, a company by the name of Comparex that recently had a transaction with one of our top partners here in the U.S. called Cloud Bearing. So with that, I'm going to bring out John Havlick and Nick Vosberg to tell us their story and spend some time with us. Thanks, Nick.
Thank you.
Thanks for coming out. Hey, John.
Thanks.
Appreciate it, guys.
Glad to be here.
So, guys, just Q&A time here with me and you. So, John, I'll start with you. When you embarked on building your U.S. strategy, you were looking at different approaches to making your way into the U.S. market. What made doing so, what made embarking in the U.S. market attractive to you?
Well, one, we're a German company, so we've been in Europe for 30 years. But entering the largest IT market in the world was quite attractive to us.
Yep.
So it was a pretty simple equation. Largest IT market in the world, we should be there. And that was the highly scientific research that we did, right?
Yeah.
But leading us in that decision-making is geographic expansion is one of our core strategies. So we went for that reason as well.
Makes sense. And you guys do a lot of M&A activity.
We do.
When you're looking at prospective buyers, if you're looking at prospective companies, what are the key attributes that catch your eye?
We look at a lot of acquisitions, and we've done a lot. In my time here, we've done them in a lot of emerging markets as well as in mature markets. So what always catches our eye is an owner that has a clear focus and has a clear strategy. I don't mean a documented 3-year strategy, but is really clear about what their core portfolio is. A lot of times it's tempting to chase every opportunity that's in front of you, but as we get out and we talk to these companies, you know, when you're a small team, you have to have focus in order to make profit and succeed. And if they're focused on too many things, you can kind of see that in the P&L. Not, you know, 3 of the business lines aren't going so well, 2's going okay, and maybe it would just be best to double down on 1 and really make it good. So we see that as a consistent theme. And then another thing is, one attribute that's hard to define is more of a, if there's a cultural fit. We first met Nick, and we had a great first meeting, and a lot of it comes off of that first meeting. And if there's a personality fit and a company fit, and that's much more harder to define. It becomes very little about the numbers. Long term, it becomes, can your team succeed inside of our organization, and do the cultures match up?
Well, there's definitely an art and a science to this, isn't there?
Sure, absolutely. I would definitely say that.
And that concept of, you know, I would rather be the best at what I do than number 3 or 4. That's going to drive the higher attractive nature from a buyer if I'm the very best at what I do than if I'm just one of many that's doing something today, right?
Yeah, true. And I think you know your business a lot better when you have one core focus.
Yep.
And you can drive your profit there. And also, if you make mistakes there, you know which mistakes you make. I think a lot of the companies that we talk to believe that everything needs to be perfect, and we're all running businesses ourselves, and we know that that's not realistic.
Yeah.
So it's not so important if the numbers are so great and everything's the way you think it should look. It's more important that you know the numbers and that you know the business and that it's consistent in its delivery, either a delivery of a negative number or delivery of a positive number, but that's really important.
Sure. And if I'm a partner in the audience today and I'm thinking about how I want to maximize my valuation, what are the big challenges that you see many partners facing today and areas that they may want to focus on working on?
I think a lot of them were touched on in the keynote this morning. It was really interesting. We see that effect in the valuations and the multiples that we pay for businesses. We've bought many businesses. I've been involved in a lot of transactions where there has been some really critical IP that made us look at the business a little bit differently than we did if it was just a resale or transaction business. Sometimes we look at acquisitions for different purposes. If we're in a market, it's a new market for us. For instance, let's say India, we needed local know-how, we needed local knowledge. So sort of the portfolio on offer was not as important as the local know-how and knowledge of taxes or whatever situation there is, you know, that we're not that familiar with in a new market, like Brazil or Mexico, where we've also done deals. So it's a mixture depending on the type of country that we're going after.
Sure, that makes sense. Well, Nick, tell us a little bit about, so that we can become familiar with you a little bit more, tell us about your company pre-acquisition.
Sure. So the name of the company was Cloudbearing. At acquisition, we had about 28 employees. We were laser focused on Microsoft solutions, so I think that's one important element. And we were specifically focused on Office 365 migrations, as well as Azure when it became generally available. To John's point, we really put the blinders on and stayed focused on our market and our key, and we're able to expand and grow very rapidly and grow within the channel and get known for our expertise.
Sure, and what made you decide that now was the moment to sell?
We knew from the beginning that cloud systems integration was going to be kind of the modern gold rush, that at a certain point the market would become flooded with competitors. And to quote one of my favorite movie characters, Gordon Gekko, the game is about capital reserves, and if you don't have them, you can't piss in the tall weeds with the big dogs. So we looked for a strategic investor, and
that's one of the lines that made me like Nick a lot. Why we did it.
We looked for a strategic investor because we had the ability to go from 2x to 10x with the right partner.
Yep.
And Comparix was definitely the right partner.
That's a great story. And, you know, Mike talked a lot about it being a journey, you know, from the beginning to the end of the acquisition cycle. And there's many different hiccups or challenges that come along the way. What were the biggest challenges that you saw through the process?
We were lucky in that we had the experience from previously having done a couple of acquisitions ourselves and been part of M&A. So one of the lessons we learned from our past trial and error was bringing in an advisor to help us get ready for the due diligence. That effort in itself is a full-time effort and exhaustive for your staff to go through. So having that extra help was critical and helped us attract someone like Comparix to the table.
Sure, so it's definitely a marathon. You've got to be ready for it, right?
Yes, definitely. Yep.
So John, I know that we're talking today about a US-based acquisition, but your purview is a much bigger area. You oversee a large piece of the business globally. So you have perspective that many don't in terms of a global view on things. What is your perspective on the trends and transactions that are taking place around the world for some of our more international audience?
We're definitely seeing a consolidation of, in the space, and definitely seeing those that can scale succeed, and those that can't scale be sort of pushed to the side. And there's a theme about scaling that's interesting. It's an easy word to say, but it's really hard. It's not your systems. It's everything. It's your processes, your systems, your people, and I think your strategy. When we go around and we look at all these different countries and we go to do these acquisitions, we're looking for companies that have proven that they can scale and can continue to scale some more with our support. And our support comes in the, in the form of maybe a global system we can provide them to help them on that front, or capital, or whatever things they may need. But truly, it's that core nugget that has to continue to scale, and trying to identify that nugget in the different markets is challenging at times, and especially in emerging markets. There's so much opportunity in an emerging market. There's not a lot of players, and you may have an RFID practice, and then you've got this Microsoft practice, and then over here you're deciding you want to go after Cisco. And you've got 40 people, and the country's got 1 billion people in it. We've got to pick something and get good at it. So it goes back to that, I think, that focus and that previous history of being able to scale.
That makes sense. You've got to do everything you can to make 1 + 1 = 3, right?
Yes, or 1 + 1 = 9 in the case of our company.
Even better. So I asked Nick about his challenges or any bumpiness in the road. What were some of your challenges in the onboarding of Cloud Bearing?
I think most of them, we don't have that many, but we've taken a very nimble, quick, cloud-focused solution provider and thrown them into a business that's been around for 30 years. We're new to the US, so we didn't have a lot of legacy issues. We've handed Nick and his team robust systems that are really heavy-duty systems that are driving really large consulting and services teams in Europe. We also have some standards, and I think the Cloud Bearing team was playing around with different project management tools, different ticketing system tools. Well, we have one global tool that we use. So we don't, I think they were nimble and like to play around with technology. We've given them a German system that's highly scalable and said, this is what we're going to use going forward.
German systems are never efficient.
Extremely precise.
Heavy sarcasm.
Yeah, extremely precise, and it's going to help us scale Nick's business, which is what's so great about it. Yeah. But at the same time, going through that integration process, like all things, we're putting our projects in there, we're trying to figure out the rhythm of the business and putting that rhythm of the business into our system. I would say that's probably a challenge, but it's not. We have not really had a lot of huge challenges because there wasn't a large legacy business in the US, I think, to integrate them with.
Yeah, that makes sense.
Yeah.
So Nick, you were on the sales side, and we've got a lot of owners in the room, I would imagine, that are thinking about this as a topic, maybe for the near term or the long term. What guidance, since it's fresh and you've just recently gone through it, what can you offer in terms of guidance to the folks in the room today?
In some of the lessons learned from the past, too, I think one of the things that we undervalued in the initial businesses that we built and sold was how important the cultural fit was. So this time around, we really concentrated on that in terms of how our employees would mesh with the overall culture of the organization, if we would truly be able to retain all of our top talent, because that's really what you put all of your investment into is the recruiting and retaining of those people. And you don't want to lose that value the day 2 after the acquisition. So I'm really happy that we have 100% retention of all of our people now 10 months after the acquisition. And I think that's because we paid so much attention to culture.
Yep,
So.
That's not an easy thing to do,
Right.
to keep them around. Well, guys, I can't tell you how much I appreciate you sharing your story with us. It's fantastic. I think there's a lot of insights gained from the audience today, and we actually have a little bit of time left. And so what I want to do is I want to bring both Mike and Mark back out and actually conduct a full panel opportunity for you to ask us questions. So there's mics in the aisles, so feel free if you have an interest to jump up and ask any of us a question. We're here to answer them for you. Lights are going to be a bit of a challenge here. Okay, we've got one question here so far.
Hello. From a global perspective, what would you say are the most popular geographical regions? And could you divulge a little bit about their buying patterns?
I know, Mike, you want to start us off on that one?
Sure. I think, I like Brazil. I think Brazil is an interesting market right now. There seems to be a lot going on there. There's been a lot of talk about Germany. Big fan of what's going on in Germany. They're I guess they're leading the EU from an economic perspective. And Asia-Pac's got a lot of up and coming. There's a lot of interest in Asia-Pac when we look at it within our customer base. The only comment I would make is that technology in many ways is the great equalizer. We see a lot of interest, a lot of upside when we think about things like cloud. It's universally growing at an exponential rate globally. So, these are kind of hot points, if you will, points of light in the market. But overall, the market's pretty good right now.
Right. I don't know, John, if you want to add. I asked you that question earlier about diversity in the markets. If you have anything else to add to that?
I would agree. It's all the high growth markets, the BRIC countries, Brazil, Russia, India, China, Indonesia, Mexico. There's all the different acronyms now.
So we've added to BRIC.
There's BRIC TIM, which is Turkey, Indonesia, and Mexico, and we just entered Turkey.
Okay.
Yeah, so these are the hotter markets, I think, at the moment.
Yeah.
Yeah.
I would have never guessed some of those more emerging markets are seeing that much traction and activity.
Large young populations in Indonesia, a workforce that's in their 20s, 200 million people.
Yep.
A good import-export balance in Indonesia, so that's another market. I think, immature market relative to the U.S. by far in terms of technology spend, but it's clearly going in that direction. So,
very interesting. Any other questions? Don't be bashful. There's one more.
All right. A lot of the content that was really well put together today seemed to have a lot to do with services-oriented businesses. As an ISV, I was wondering if there were anything particular or specific to that type of business that might be more applicable.
You want to start with that one, Mike, and I'll add to it.
Sure, absolutely. I think that ISVs in many ways are the tip of the spear, right? I mean, when you think about the value add you bring to the Microsoft stack and what occurs in the market, it's really the business case for IP. I think the new more modern partner, as Phil talked about today, is one that can take that technology and really implement it. And the lines are getting kind of blurry. I call it the product-enabled service model, right, where that technology ultimately gets implemented and pushed out through a competent services channel. Now, for ISPs, I think, or ISVs rather, the ability to create a channel, an effective channel of services implementers is critical. And when you begin to think about valuations, I think all the general observations I made are correct, other than the valuations tend to be more left or higher because of from a multiples perspective. So if you were to think about it from a benchmarking, you guys are pretty far left on that range of multiples.
Yeah, and there's a couple things around ISVs that I particularly like and have seen through my observations as well. And it's, they've got the revenue model that's focused on higher gross margin, which is beneficial, right? So you're going to get a better rate there. I've also seen it, in many cases, provide a more defensible strategy, meaning the competitive entrants, it's harder for them, and so there's not as much risk in that regard there. The other thing, though, too, around the ISVs is that element that Mike talked about is how do I build scale, right? Because a lot of times from a challenge standpoint, it's both on the sales side and the support side, right? How do I attract and acquire customers at a rate that will drive the growth that I need, but because I'm really good at building something, but oh no, I've got all these customers, how do I support them and take care of them and make sure that they don't churn? It's making sure that you get that balance of equation in place to ensure that growth can be perpetual as opposed to a short-term thing with a plateau on it. Any last questions?
Yeah, we spoke a lot about business transformation here, and we spoke about what's really hot now, cloud and analytics, metrics, and so forth. What's your projection to what the next trends in technology are, since they're moving so quickly and so fast? We have IoT and mobile and things of that nature.
So Mike talked a lot about SMAC. I think it's still a fun term. And I think this week you've heard a lot of our perspective of Microsoft, of what is in front of us with the analytics and the IoT elements. I think there's not only new markets that are opening up, but new revenue potential where potentially you sell an offering to a customer, but rather than charging them for it, you do a sharing of the proceeds from the benefit of having that business outcome impact their business. I mean, there's all kinds of new monetization models that are coming up now, and we're seeing some interesting ideas start to percolate in the channel. But I think this question is actually better for the partners to answer. How are you guys thinking about these new technologies that we're offering, and what are your plans to leverage them to maybe increase your valuation of your business?
Yeah, I'll take a stab at that as well. I think the tools are great. You hit on it. It's obviously social, mobile, cloud, analytics, big data. Some of the things out there towards IoT are great. The one thing that I'd say is that those are all technologies. They aren't business transformations. And so in as much as those can be enablers, a lot of our business process strategy and business process reengineering and innovation centers that we do, or sessions with our clients, are all around how do we leverage these things that are out there, HoloLens, sort of all the social, mobile, et cetera, towards your business, and how do we talk about it from true transformation, whiteboard sessions, business case development, and really, in essence, not building an RFP that will be sent out, and if it is, we help to design it, understand it intimately. So having the business strategy that then can be segmented or allowed by technology, I think is the key discussions, and all the rest will come into play. So I'd focus with the business.
I don't know if you guys want to add anything to kind of your perspectives on some of the things you heard this week, or if...
Yeah, I think a lot of the value being wrapped around what used to be a transaction of decades of old, and now the value that we're wrapping around that, it's so much less about that now. And another reason why we partnered with Cloudbearing was to get that sort of solution-based messaging in the marketplace that addresses customers' pain points. We do not go to market and say, hey, we want to sell you Azure. We go to market with backup, disaster recovery, single sign-on in the cloud, and some other infrastructure packaged offers that we can have. And Cloudbearing was a fit to help that happen for us in the US. But I think going to market, we've been talking about solution sales for decades, and I'm sure all of us have been through a billion trainings on this. But I think we're here now. Mm-hmm. And what you hear in about how you increase multiples, how you increase higher value, it's recurring revenues that are coming from not selling transactions, but selling solutions, right? And it sounds very simple, but I think we're finally arrived at that point.
Yep, I think that's a great perspective. And guys, I know we're a little tight on time, so I want to thank you all for joining me. I greatly appreciate your insights, and I know that I found value in it, as I'm sure the audience did. So guys, thank you very much. And I'm sure these guys will stick around too for a little bit if we have any lingering questions. But real quick, I just wanted to highlight a couple of resources for you to take away as you leave WPC. There's 5 things that we've produced related to partner profitability that I think would be of great interest. The first is we have what we call the Partner Profitability Challenge, which is a fun, innovative way for you guys to engage with the training that we have around this topic. And we've gamified it, so it's intriguing to take advantage of and use. The other is we have a destination for partner profitability on MPN that you can go out and find all the best assets right there, anything that you need on this related topic. I highlighted the scenarios in Cloud SureStep earlier on in the presentation. There's the short vanity URLs for you to take advantage of. And then I know that marketing is a white-hot topic. If we're talking about building recurring revenue, we've got to attract prospects at a much higher rate than we did in the past. This particular destination has brought together analyst research from IDC and best practices from other partners and married those with the tools that we have available to you today. I highly recommend you investing some time. These tools will help you in the digital marketing space greatly. So with that, I want to say thank you very much for investing the time, and I hope you enjoy the rest of WPC. Thanks, guys.